Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In this video, I'm going to talk about one of my all-time favorite companies. This was in my portfolio about a year or so ago. I sold it, I took some profit off the table. As soon as I sold it, the stock took off completely, and it's been going up to the right for quite some time. And now it feels like for almost, since the beginning of the year, it hasn't done anything. It seems it's either undervalued or potentially getting undervaluation sort of territory. So what we're going to do is we're going to look at the financials of the business to understand how this company makes money. We will see the metrics that we normally look for, things like does it have a growing revenue, growing EPS, free cash flow side of things. We're going to look at almost everything we need to know about this company in the next 10 minutes. I don't want to make the video longer than it needs to be, so we're spending 10 minutes, but again, you're going to have to go away and do a little bit more research about the business. Of course, as always, because remember, I'm not financial advice. I'm giving you some basically ideas of what to research about, and then you're going to go away and do your own thing, inshallah. Now, the current market is crazy. Things are going up to the moon, but there's a lot of companies that still basically have not done well since the beginning of the year. And this is why I'm now, in the next few weeks, I'm going to spend, inshallah, just to finding those companies and sharing it with you. And last night, I spent, I think, about almost 3 hours doing research on those type of businesses. I put together loads of different companies that are, and I'm not talking about just any company, I'm talking about top companies that I want to share with you guys in those 10-minute videos that are coming up in the next few days, inshallah. So if you're enjoying this type of content, like I've always said to you guys, press that like button, because it takes a lot of time and effort to put these videos together. Now let's get started. The company that we're here for today, and also, by the way, don't forget to join us to the Patreon account. It really supports the channel, as well as, of course, you get something out of it. Things like I would normally share with the family portfolio, anything, all the buys and sells that I regularly make. As soon as I buy something or sell something, I'll share that with you guys, and you get the dividend trackers, and then of course you get a free access to the Discord as well. So, but that is free. You can just go to the description on this video and you can get access to that, inshallah. The company we're going to talk about today is Intuit. Intuit has loads of different products, including QuickBooks, TurboTax, Credit Karma, Mailchimp, and so on. And once users and businesses are embedded within their system, switching is costly in time. It's basically with regards to data migration, integrations, and learning, and all of these things. Once you are in that environment, it is very difficult to move, which gives this company a wide moat. Its QuickBooks Online has a network effect basically for accountants, and once they use it, they don't like switching it to other, basically, of course, the products out there. And this is one of the reasons why I love this business, because I love any business that has a wide moat where once you're in that environment, it is very difficult to switch, and most companies will not want to switch, of course. And it has a strong brand, and for that reason, it will be barrier for anybody who's new to actually enter those markets, because this company, the QuickBooks, for example, it's a very well-known product anywhere in the world. Some people don't even know the company, but they know the product first, which is quite nice to know. When it comes to the financial and strength side of things of this company, I love the fact that they have a subscription model side of things, recurring revenue in nature, which is really, really good. I love that side of things. Once you have that recurring revenue, it's very difficult. On top of that, you've got a wide moat. It's very difficult to switch from those kind of things. So, and a couple of other things we're going to look at, of course, the fact that the company has a low debt, good balance sheet, and so on. So I'm going to share all of that information with you guys, and that's exactly what we're going to start with. So let's now have a look at learn a bit more about the company. Again, you've got the company information if you wanted to know more about it, but as you can see, it has a market cap of 179 billion, small dividend if you think about it, dividend safety of 98%, credit rating A-, basically, which is really good. So that's a strong. It seems undervalued at this point in time. The growth for the recent growth for that dividend was about 15%. Beta is slightly high because this is a quite volatile stock. Now, payout ratio is 21% for that dividend. That means they're spending about 21% of their net income to pay that dividend. 15%. We've already seen that last 5 years about 14%, which is really good. It's growing nicely. 13 years of increasing that dividend, $4.80 for every share of that company, basically the thing of this company that you own. Last 5 years, when we use the dividend theory sort of a valuation, you can see that normally what we're looking for, if it's that dotted line is inside, that means it's kind of fairly valued. Above it, that means overvalued. Under it means is undervalued. So at this point in time, it seems undervalued. Now, a couple of more things we need to look at. Earnings payout ratio is declining, which is good. So they are bringing that down, which is nice. Free cash flow payout ratio is also declining. Earnings per share, look at how beautiful this looks. I really like that. From $3.78 to right now over $21. Free cash flow per share is also heading the right direction. Shares outstanding is not great. They haven't been buying their own shares, which is fine, but they haven't actually diluted it for quite some time, and I like that. Total sales for this company, we're looking at about, you look at that from $4.6 billion to right now $18.8. So that's an $18 billion of revenue side of things. Return on equity at 20%, return on invested capital 15%, operating margin of 26%. Free cash flow margin of 33%. This company has excellent free cash flow margin. I really like that, and almost no debt whatsoever. Now, a couple of things that we need to look at historically. If we used in fast graph, for example, you can see where the price, this is the earning side of things. Basically, this is that line, black line is the price. You can see the company has been expensive for quite some time, because when this, the stock is below, the price is below this orange line, that's when you expect the stock to be basically undervalued. But as you can see, it's now around the normal PE, just basically around what it trades. Normally what it trades basically per year, every single year. So that normal PE of 30 is where it's at almost right now. So it's interesting to see. It has a blended PE of almost a 31. If we look at the performance over the last whatever years for this company, because in the end of the day, there's no point buying these companies if you're not going to outperform the S&P 500. You might as well just buy the index if you like. Of course, it's Shariah-compliant ETF if you like. But yes, 18% over the last whatever years, 10 years. And so if you had invested 10,000 basically in 2005, basically in 2000, that's 20 years. Okay, 2025, you would have had at least, how much is this? So $267,000 US. That's absolutely amazing. So that's about 18% basically compound growth rate, which is absolutely amazing in comparison to that 10% of the S&P 500. So you would have actually outperformed the S&P 500 over the last 20 years. If we look at the forecast now, if we're using the estimates, which is about that 13%, and when it comes to the revenue with the EPS side of things, of course, this stock is overvalued. But if we use the normal PE, where the company has been trading over the last whatever years, if you buy the stock right now and basically sell it in 2028, you would be making about $8,257 on the top of basically what you initially paid for, which is quite interesting. So it's not cheap, but it's getting there. Couple of very quick things. Earnings per share, so the expectations moving forward, as you can see, like we've already seen that, so 13 sort of a percent. Revenue side of it more or less the same. Wall Street is actually saying it's a buy right now. We've got 19 strong buys, 6 buys, 7 holds, 1 sell, and as you can see, 26% upside from where we are. If you haven't pressed that like button, please do so. It genuinely helps the channel. And now looking at the stock valuation that we normally use, I'm going to show you the discounted cash flow model that I use. So this is the free cash flow the company has generated over the last whatever years, which is average of about 25%. I'm sort of kind of predicting about 12% moving forward, just being cautious a little bit. And that sort of gives us basically $734 for this company for the current price. Morningstar saying 720. Simply Wall Street is actually saying 735. Seeking Alpha 818, which is basically what we just saw, and current price is $641 per share, and which means it's a buy right now. But if you just say to yourself, you know what, I need that extra 10% or so for margin of safety for myself, you can buy this stock right now. But if you say, you know what, maybe a very volatile company, anything can happen, a new company can come to the market, whatever the case might be, you can give yourself 15% and you can still buy this stock at this point in time. So that gives you about 15% margin of safety. But yeah, overall a great company. What am I doing moving forward? I will definitely be looking at this company in the next few weeks. Any drop, so I'm not going to buy basically a full position yet, okay, because I don't want to do that, because this is, let's say this is a high quality business with basically, and it has a durable moat and recurring revenue and capacity for reinvesting that money and so on, and with AI and tailwinds, all of these things are great for this business. But also you just have to be cautious basically buying these type of businesses when they are trading higher multiples and they're quite expensive. This one seems basically fairly valued at this point in time. It sort of basically seems discounted at this point in time, if you like. Everyone is basically more or less kind of predicting it to be undervalued at this point. But if you give yourself that extra 10%, and just buy a little bit, just one share every couple of weeks or whatever, then that will be better than actually buying a full position. And that's what I'm going to do, inshallah, moving forward. I'll share with you guys as soon as I actually initiate the new position. But that is the one company that I'm looking for, inshallah, to add to the portfolio, that has been in the portfolio but is going to come back at some point, because I do like the growth, I do like the dividend side of things and everything else about the business. So there you have it. That's the company I wanted to share with you guys today. If you haven't joined us in the Patreon account, please do so. It really genuinely helps the channel. Have a wonderful day. Assalamu Alaikum.